name is Eleanor Taylor-Jolidon, and I'm joined here by my colleague, Martin Moeller. We are the co-heads of the Swiss and Global Equity team at UBP. Martin, last time you spoke to UBP on one of these podcasts, you talked about the fact that you expected growth, momentum, and quality to continue to outperform against cyclical, value, and reopening post-pandemic trades. Has your thinking changed over the summer?
Not a lot, and what we have seen so far is actually that, first of all, markets kept going up. We are now at 3.5% total return year to date for MSCI World, and we made new highs in September. Now, as we speak, trading around 3% below that September high. And style-wise, indeed, growth and momentum and quality were dominating over cyclical and value stocks, which were only temporarily outperforming. But how did it go for Switzerland this year?
Indeed, very similarly for Switzerland. We're also just below the February highs, both on the all-cap index, Swiss Performance Index, and the small mid-cap index in Switzerland. It's true that if we look at the H1 results in July, they were a little bit mixed on Switzerland, notably influenced by the weaker dollar, which does have an effect on earnings in Switzerland. But in fact, we're noticing now that a lot of earnings are being upgraded across the market for Swiss companies, and the numerous contacts that we have through the year and have continued to have through the pandemic are generally quite supportive for companies, notably into 2021. Bearing in mind that the Swiss equity market is heavily biased towards healthcare, there have of course been a number of companies which have benefited from the pandemic, being able to offer specific products, both in the diagnostics field, but also in the treatment field, which are of particular interest within the pandemic setting. But moving beyond that, there are other sectors and companies which we also have been encouraged to see opportunities for growth going forward. Think of some building materials companies. As we consider better hygiene in buildings, some of these companies will have a stronger growth coming through for some of their products. And we're already seeing this in some markets which have come out of the pandemic earlier than others.
That's probably also true for needs for air conditioning, and also the whole trend towards like smart buildings is not really changed by the situation, right?
Absolutely. And I'm sure you can think of some examples globally where we are also seeing strong trends behind them currently.
Yes, absolutely. And talking about the smart buildings, it's certainly the whole environmental part that is still playing a strong role. We see strong performance from solar, wind companies. Utilities are continuing their change of highly pollutive electricity generation towards more cleaner ways. And that is something that gets rewarded in the market. And what about valuation? Because that's often a concern for people.
Well, certainly the Swiss equity market is often considered to be an overvalued market. And it's interesting to see that currently we're actually trading at a PE level which is below that of the S&P 500. We would say that these slightly stretched levels of valuation in markets at the moment are typical of a situation where we have had a strong disappointment in earnings linked to the pandemic. But with expectations for the rebound in 2021, we come back to range-bound valuations going forward, and we would continue to consider this an attractive level at which to invest in equities.
Yes, obviously, 2020 earnings are not looking good, and I think the market is focusing rightly on 2021. And on the global side, we are trading there around 18 times earnings, which is also something reasonable from my point of view. After the downgrades that we have seen, we are now seeing small upgrades to earnings, and we would expect also GDP growth to accelerate from here, which would justify a somewhat higher level than what we have seen in the past. And what are you hearing from companies when you think of your most recent contacts?
Well, certainly there are some more cyclical companies which are withholding guidance for 2020, unsure about how the second half of the year will develop, notably whether we will have catch-up trades in some areas or a second lockdown, which would obviously slow down their activity. But if we look at the companies that we focus on, the ones which are able to create value through the cycle, they tend to be the companies which are either able to offer a guidance already for 2020 or maintain the guidance that they gave, or indeed give very reassuring statements as regards 2021 and beyond.
Yeah, that's what I'm seeing also on the global side. Yeah, sequentially it's better, but some areas are seeing somewhat less momentum, maybe thinking of US retail, for instance. Companies are noting that there's no further reopening progress actually beyond the May and June period. However, the winners continue to have the more optimistic views. What about the political risks that you see for the rest of the year? I'm thinking of developments in the UK and also the US election.
We have got a heavy political agenda ahead of us. Quickly on Brexit, I think this is really a situation where the effect is limited to the UK. We must remember that if we look at Switzerland, there's only about 5% of exports from Switzerland which go to the UK, indeed revenues for companies. And if we look at Europe, I think it's also about 8% of exports from Europe to the UK. So I'm not overly concerned about what Brexit would mean for the Swiss equity market or indeed global equity markets. As regards the US election, it's interesting to see that so far equity markets seem to be looking through any risk linked to those elections. Indeed, Mr. Biden is a relatively middle-of-the-road candidate on the Democratic side, and Mr. Trump is linked to a situation where equity markets are expected to go up. I think both candidates can support both growth and equity markets in different ways, and depending on who is elected, an active investor will allocate as is appropriate.
And Biden tax hikes, you think that's a risk for the market? I think it might be compensated with some other parts of his program, right?
Absolutely. If he does have a stimulus program, what you lose on a tax hike, you will probably gain on better earnings. And I would actually point out that a Republican win could lead to further uncertainty regarding trade differences between China and the US, and that also needs to be borne in mind. And I expect that is what we're seeing on equity markets currently, is that the outcome is not expected to affect the whole market one way or another, and it's a fairly neutral situation for equity markets. But finally, if we consider what you were saying in June and these political pressures and the current equity market levels, how would you recommend people to invest at the moment?
Well, we continue to prefer clearly investing into value creative business models over the so-called value stocks or the more cyclical end of the market. We have seen value creation to outperform over the cycle, over long periods of time. And we are seeing also going forward that this is an investment theme with lower risks. We just need the cushioning that is coming through currently from the fiscal, from the monetary side. We don't need an overshoot of the economic growth, which would clearly be needed to be more optimistic on the cyclical side of things. And also it's our structural observation that these value stocks where value creation is low across the cycle are still overestimated in terms of their value creation capabilities. And that's why preference stays on the value creation quality end of the market. Thanks for listening, everyone. For further information, please contact us or visit our webpage at ubp.com.